This is Brad Sanders, and this is your investment update for March of 2020. March of 2020 obviously was not a lot of fun due to the COVID-19 virus and what that's done to the economy. We had the domestic stock market, S&P's down 12%, bringing year to date down over 19%, and global equities were down over 14%, and they're down 22 to 23% year to date. The average stock in the stock market, both those indexes are cap weighted, meaning they have a lot of mega cap stocks in them. But if you look at the entirety of the stock market, the average stock is down 38.5% year to date. So it's been quite the ride down in a very short period of time. I've been getting a lot of questions because the bond market was also negative in March. You had the domestic bond market down over 0.5%, and the global bond market down over 2%. And a lot of people are going, well, I thought bonds make money when you have a bad market. Well, in general, they do. Things like treasuries do, because the US government has a printing press and they're not going to default on those. And when we have times of crisis, everybody floods to those. And when you have normal market drawdowns, normally the bond market does go up. But what's happened here is we've also had credit problems where you've had corporate credit bonds spreads blowing out and people trying to sell those because they're, companies are shutting down too. And so you've had all the losses there offsetting the gains in treasuries. And what you have is a net, slightly down market, almost flat here in the US and down a couple percent overseas. But, yes, treasuries have made money, and, higher rated safe credits were flat, but anything less than that was down. What we're seeing now, the Federal Reserve came out 2 weeks ago now, or over a week ago now. They all run together these days. And they fired what we call a bazooka at the market, where they did unlimited quantitative easing, which just means they can go out and buy whatever they need to buy to put on their balance sheet in order to shore up liquidity and shore up the financial markets. And that's including things like corporate bonds and other types of fixed income instruments, and even ETFs in some cases. And what that can do is calm financial markets and calm the bond market, which in turn should help the equity market at least try to stabilize or rationalize. What we saw when you're having 10% swings each way every day, that was caused a lot by the credit markets melting down. You get the credit markets are multitudes bigger than the stock market, and you have all these big pensions that are invested in bonds. And when they need to, go to cash or raise capital, and they're trying to go to their bond portfolio, which they're supposed to say they don't want to sell stocks when they're down over 20%, they'll sell their bonds. But when they go to the bond market and they're getting bids back of 50 cents on the dollar, or maybe no bids at all, they're forced to sell equities. And anytime you have bond stress like that, it just creates waves and waves of selling in equities. There's no situation where the bond market is selling off the way it was and stocks go up. And so what the Fed did is offer all this liquidity. And what that's going to do is that's going to help stabilize the bond market and keep those spreads from blowing out as hard as they were, and keep liquidity semi in check. And that's going to allow the equity market to breathe a little bit and not have all this panic selling on top of it. What we're looking for going forward is the equity market to continue to remain very, very volatile. We're just in a situation now. Stocks or cash flows of companies discounted back to present value. Well, the market hates uncertainty, because when you have uncertainty, you cannot estimate what those cash flows are going to be. And now we're in an environment where those are sometimes even in doubt, depending on what industry you're talking about. So you can't really risk manage by buying stuff and knowing what the value is in this scenario, because everything's in doubt. So that's just going to cause the market to hyper react to any kind of news coming out. And we're entering a phase where we're going to start to get corporate earnings from the first quarter that are going to include February and March. So we're going to get a little prelude of what we can expect going forward from certain of these companies. And that's going to hopefully help at least the market to kind of find some traction somewhere. But it's still going to remain very, very volatile. That's our baseline expectation. And so what we're doing is leaning on our managers to allow them to work through this and reposition our portfolios as things can get cheaper, and to be very measured and thoughtful about any moves we've made. We were lucky enough to get out of a lot of credit last summer and things like that. But we want to make sure that we're making good long-term decisions here, and we're not panicking ourselves. So we've been working very closely with the Kane Waters Investment Committee. We talk almost every day. via email or Zoom meetings, where we're just thinking very rationally, keeping in contact and making sure any decisions we make going forward are best for our long-term financial plans and not something in the moment that we're feeling that day. Because as we've noticed by the news, things can turn on a dime. I want to direct everybody that's watching, if you haven't, go to the Cane Water's website, go to their COVID-19 page. It's right on their landing page on their website. They've done a tremendous job. Any questions you have, they've already probably answered them and they're on there. I've done a few webinars that are also on there, and there's some other market related materials out there. And if you have any questions and you're busy, you can always go there and check that out. And we'll do some more of these going forward to keep everybody involved. But in the meantime, everybody stay safe and hope to see you soon.